class. Okay, so for me, one of my exciting classes is life insurance because everything we do, the foundation, the bedrock of financial planning is life insurance. And every time I talk about life insurance, oh, am I muted? Okay, no. For me, it comes naturally talking about life insurance. And I want everyone to just have fun because there's this misconception, or rather this thought that, oh, life insurance, especially preparing for an exams, is the elephant in the room, is the monster of all of them all. But the reality is that everything we'll be learning, both in ethics, in sec funds, it all comes together in life insurance. So um on that note, I want everyone to feel at home, feel comfortable, and I'm going to try my best to explain every concept in this course with everyday scenarios and examples that we can relate with. Okay. Basically, what life insurance is all about is all about risk. Okay, it's all about risk. Death is a risk to which everyone is exposed to. Okay, life insurance agents needs to help clients understand the reality of this risk and the need to address it. You see, knowing the reality of something is one thing, and then taking the next step regarding the need to address it is another thing. And sometimes there's a temporary comfort that one gets from not knowing something, or for basically living in denial, so to speak, when you close your eyes, to the existence of risk. But that doesn't mean it's not there. It's there, but closing your eyes in that moment give you some temporary relief. But what actually gives permanent relief is acknowledging the risk and addressing it. And that's basically what all this is all about. Okay. Um, Life insurance, in essence, is that there are parties to life insurance contract. We have the insurance company. The insurance company assigns, is an individual that is licensed, you understand, to offer this life insurance. And it consists of, people or wherever management that manages life insurance companies. I think we've looked about life insurance companies, the corporations, their licenses, their authorities, and all that stuff. Okay. Um, Another thing we need to know in this course is also the fact that the risk of death is based on life expectancy. Okay. And the insurance company has a way of calculating this life expectancy, and there are some data to back that up. We're not going to go into the details of the table or the data, or how the insurance company calculates those statistics or whatever. Okay. All right. Yes, as you can see here, there are some tables here these are statistics that is pulled from existing data to let us know, or to give us an insight as to mortality rates in male and in female, and by their ages, right? You can see that at age 60, 70 something percent of men, right? Life expectancy year, in men, and that in women. Hmm. So men are prone to die younger than women. All right. Potential financial impacts on death. In fact, we cannot overemphasize this one. I always tell people that living in this part of the world, everything is hinged on two incomes. Like when two people are together and they do things together, um, you know, and that is how their liability, that's how big their liabilities is. And even when it doesn't have to do with two people, it could be one individual. As an individual, you have a house, there's mortgage, there's so many things. So debt impact on our finances is huge, right? So addressing that is very key. You understand? If you don't address it, for instance, I'm holding this pen. If there's nothing else to hold this pen and I remove my hand, see, what do you think will happen to this pen? It's going to fall right down. But if there's a pillar, let's say this hand now, this my hand now, this my fist is a pillar, and then this pen is here. I could easily remove my hand, and then this pillar will hold the pen like this. So when we talk about life insurance, we are talking about building a pillar that will sustain, you know, the lifestyle, the people we love, the people we care about in the event that the unexpected happens. Okay. Um, You see, the life insurance paid death benefit that is tax free, that could go a long way, to the beneficiaries of the life insurance. All right. So we'll be looking at it chapter by chapter in the course of our course. Now, moving further, because these are all preliminary introductions to give us a background understanding of what life insurance is and what it tends to address and all that stuff. Um, for instance, if a young father who is a primary income earner dies, the death benefit is available to his family, of course. And then the loss of a caregiver. Now, for instance, if a mother who looks after the children at home dies, then the debt repayment option. See, this is telling us things that our life insurance benefit can come in to take care of. When we use, like, that's why we always say that the life insurance is a bedrock of financial planning, is a solid pillar of financial planning, because when we have it, even though what even though anything happened, that pillar, that support is always there, right? And of course, income taxes, upon death, an individual is deemed to have disposed all his property at fair market value, unless rollover or tax exemption provisions apply. Taxes are assessed and our capital gains must be paid. You see, the executor may have to, sell assets if the estate does not have any sufficient funds to pay, the resulting income tax. And I tell people all the time, every time I talk about this section, I say that dead people pay tax in Canada, in United States, in most of the first world countries. Dead people pay taxes. And why is that? Because when we passes away, there are capital gain, because our assets are deemed to have been sold at fair market price upon death. You see, the way the law look at it is that the law see, like, you just before you died, just before you took your last breath, you have sold everything. It's crazy. It's presumed that you sold everything you possess just before you died. And because you have sold everything you possess at fair market price just before you died, so there will be capital gains. Imagine if you bought a house in 2010, let's say you bought the house at 400 at the time, and right now the house is going for 650. So that is a capital gain tax of 250 right off the back, and 50% of 250 is 125. So there is 125,000 capital gain tax that will be paid based on your tax bracket. So if your property gains, if 50% of your proper capital gain is 150, that's not including any other thing. Already you're in the high tax bracket, so you're looking at 40% of this 125 right off the back. See what I mean? And then you may have other stuff. So And that's why when we say planning, have all this planning is very important, because if, and this will have to be paid before the beneficiaries will inherit these assets. Otherwise, the executor of your estate will have to sell some of your assets to raise the money to pay before distributing. Somebody booked? One day. Sorry, one sec. More than one day. Could be one of people. Sorry about that, folks. So, yeah, that's why it's important to have all this in place. All right. So we have an example here, and then that is that we also use life insurance for debt repayment, income taxes, estate creation. We can also use life insurance to create estate, that is education funding, by providing funds for university, college education, and establishing legacies, providing financial gift, upon death, to any charity of our choice, is also another use of life insurance. So I talked about the use of income taxes for life insurance. Uh, yeah, that's the one I just finished explaining, right? You see, when there's a tax emanating from capital gain tax, so there's need to pay those wherever. And I've talked about estate creation, then business impact. So yeah, you see, the death of a business owner may force the sale of the business, as well as significant revenue could be lost due to the death of the key employee. So the revenue loss could be severe, such that could put questions to the continuity of that business, right? So yeah. However, if there is a key person life insurance, so the loss of a key person, will pay out tax free some funds that could be used towards hiring and training another competent individual that will man the business going forward. But if you don't have life insurance in place for a key person or for the owner of the business, then that could mark the end of that business outrightly. Okay. Maybe we should quickly read this example here. Justin and Taya are both 30 years old, and they have three children, age 1, 3, and 4 years old. Taya currently stay at home with the children, so Justin is the sole income earner. How will this young family cope financially if Justin died? The loss of Justin's income will be devastating. Now, considering what will happen if Tanya was the one who dies, as the sole income earner, Justin will not be able to afford to stop working to care for the children unless another person could step in and assume the role of a caregiver to the children free of charge, such as one such as one of Justin's or Tanya's parents. Justin will have to hire someone to assume this role. If Justin dies, the bank is unlikely to extend the mortgage to Tanya because she is not working. She will not have, she would have to sell the family home to pay off the debt. Wow. So you see all this, but these are typical things that could happen, right? And that's why what we do is very important. So imagine you meet Justin and Tanya, and you explain to them how they could take care of their current situations with by having a life insurance in place. That way they won't have to live with the fear of every day not knowing what could happen, what they would do if anything were to happen to Justin, considering the fact that he is the only breadwinner that they have. Okay. Death benefit proceeds from life insurance can be used to help minimize the financial impact of death on the surviving family. Death benefit can also provide money to pay for a substitute caregiver. The benefit can also help to repay debt that might otherwise have been taken from the value of the estate of the deceased. Also, death benefit can help them to pay the tax liabilities owing on the estate. Okay. All right. Yeah, in continuation of that, the death benefit can also help pay for future education cost of the children. It can also create legacy by paying, leaving an inheritance for the children, or give to any charity of their choice. Okay. Now, moving on to risk management strategies. Risk management strategies is the choice or choices a person make in regards to risk he faces different on a different basis, right? Yeah, different risks can be managed in different ways. And then different people also manage risks differently, right? However, there are 4 ways in which we manage risk. This is a very interesting. You can manage your risk by avoiding it, okay? But the fact that you avoid it doesn't mean it's not there. All right. The fact that you doesn't acknowledge the existence of risk does not eliminate the risk, if that makes sense, right? Risk reduction, we can choose to reduce our risk. Um, we can choose to retain our risk. You see, and that's why I tell people that life insurance is not for everybody, right? Um, if you have enough muscles, like if I have liabilities for $1 million and I have $1 million in my bank account, I don't need life insurance because I can choose to retain my risk. What that means is that I am saying that if the risk happen, I have the ability to take care of it. See, I like that though. So that is risk retention. Then risk transfer is when some or all of your risk is transferred. That is moved from one to another. And that's what we are promoting. Because we see that many people don't have the ability to retain their risk, okay, or ability to reduce their risk. Then we show them how to transfer their risk. Don't worry, you don't need to worry about your risk. We can transfer it to the life insurance company. And in exchange, you pay premium for the coverage. That's what this is all about, period. Right? Okay. I'm going to move very quickly, please. I have 2 days or thereabout to complete the entire. So moving on to chapter 2, term life insurance. Okay. A life insurance policy is a contract. Okay. The two words contracts and policy means the same thing and is used interchangeably. So I'm going to just explain life insurance. Term insurance is the bare, is the simple form of life insurance. It's the cheapest form of life insurance, and it's more or less like uh, an insurance coverage that covers your risk. Basically, you can opt to take life insurance for a specified period of time, like term for 5 years, term for 10 years, term for 15 years, term for 30 years, or term for 60 years. Okay, but some insurance company, most insurance company, um, don't provide term insurance beyond age 80. Okay, so yeah, those are term insurance for you. Like I talked about the 10 could be for 5, could be for 10, could be for 20. And then I talked about age limit in case some insurance company, maybe even from 60, once you are 60, they won't want to sell to you. But the maximum, you can have coverage for term insurance to is 75, and some few on some few occasions until 80 years old. Okay, I've seen some that go up to 80, but they are not that many. All right. Are you guys there? Are you guys listening
Joy,
to
I
me?
have a question.
Yes, dear.
Why would somebody that did not take a life insurance, maybe at 40, 30, and 50, need a life insurance at 60? Are there cases like that?
No, there are cases. No, but most of the cases I have encountered is people that currently hold term insurance, because what they are told is that it's renewable and convertible. But what many people don't know, if including people I have been helping lately, they are carrying this term insurance right now. Some of them are in their 30s and they have this term 20, and they feel okay, it's renewable and convertible. But what they don't know is that it's renewable and convertible at what price. So you find out that you have 30 something going on 40 now. By the time you are getting to your 60, your 20-year term is expiring in your hand. So you are thinking of renewing it, right? Or converting it. Now, I've also seen some people that are in their 50s or late 50s. If I even had a man came to me, he's close to 70. At the end of the day, all the illustration I did, they were too expensive. I told him I won't lie to you. Go and save your money in TFSA, because all the policy I have been the quote I've been getting for him are expensive. But the good thing for him is that he has is it 250? He has 250 that he got since almost 20 years ago. So at least he has something. He wanted to increase it, but it's too expensive. So I hope that answers your question.
Yeah, thank you. But can't you just buy
You're
a set
welcome.
fund or an annuity?
Yeah, he can do that. Yeah, that's why I told, like, his TFSA. The reason why I recommended TFSA is the fact that he doesn't have TFSA, right? So we can put his TFSA in sec form for him. And then if he's doing annuity right now, then we can set up an annuity. But his time horizon is small. So he may not be able to accumulate much that will make him, because that's and because any annuity I'll do for him will be a deferred annuity, maybe someone that is getting to 70. Annuity has its own age limit as well. So when they start getting old like that, options start getting very slim. Yeah, so that's that on age limit. Okay, yeah, see 80 years or age 80. But but not beyond 80. Okay, policy holder versus life insured. Now, this one, I'm sure you guys know this one now. So the policy holder could be the life insured, and the policy holder could be different from life insured. So the policy holder is the one that initiate the contract, that have the contract, but it's possible that that policy holder could be different from the life insured, or they could be the same. Okay. Decision may also be made while the contract is in force, such as changing the beneficiary or deciding to cancel the contract. The decision to cancel term insurance is the cheapest, is the easiest decision, because if you don't even call, you can just call the insurance company and cancel it. Or once you miss payment, they will send you a registered mail. And once the payment is not received, in the next 30 days, your policy is cancelled. Okay. Um, Policyholder may be the same as life insured. We've talked about that one. Okay. There's an example to explain that. Now, term insurance can be Single life. Single life is that, okay, this is me, Joy. I take a 10 insurance on my life and my life alone. I could be the life insured and the policy holder, or my husband could set it up whereby my husband is the policy holder and I am the life insured. All right. Now, there is also term insurance to be set up as joint plan. Now, joint plan is the policy that covers two lives. Okay. You could have joint first to die or joint last to die. Okay. Now, if it's joint first to die, okay, and I want you to let me say this right here, that the fact that it's joint doesn't mean that it will pay two death benefit too. Once it's joint, it's still one death benefit that will be paid. Okay. So the joint one is that if it's joint first to die, so it means that when husband and wife take joint first to die, when one of the spouses passes away, the policy will pay the death benefit to the surviving spouse. Then the surviving spouse can now take that death benefit tax-free. And then maybe if they still have outstanding mortgage, pay off the mortgage, put money aside for the children's education, take care of stuff like that. So that's joint first to die. Then we have joint last to die. This joint last to die is for estate planning, and I bet you're going to like 110% certain that you're going to see a question around this, whereby they say, okay, a couple is planning for paying estate taxes, when they are gone. They don't want to do their estate taxes to burden their children. What is the best form of blah blah blah? Anyway, we'll see some of those questions as we go. So it will be joint last to die. So if a policy is set up as joint last to die, the death of the first spouse does not trigger the payment of death benefits. The death benefit will not be paid until the second spouse passes away. Why? Because when the first spouse passes away, the assets will be rolled over to the surviving spouse. All right. So, but as soon as, CRA, they are very patient dogs, so they are not in a hurry. So when this first spouse passes away, they know that, okay, our time is coming gradually. Then when the second spouse passes away, that's when, all those expenses will have all this payment, probate fees, capital gain taxes, blah, blah, blah. And that is when the money will be paid at the death of the second spouse. Then that money now can be used to settle all the CRA payments and other stuff. Okay. So that one is joint last to die. Okay. Moving on to okay, they are now telling us, okay, under what circumstances do we want to pay joint first to die, joint last to die, right? I've explained that. I've explained joint last to die. Okay. All right. Death benefit. All life insurance policies, not just term, pay a tax-free death benefit. When the life insured dies, it is paid to the beneficiary. That's right. Okay, level term. Okay, a level term policy has a set death benefit, and it is the same at the initial amount of the policy. And this is the most common and straightforward form of life insurance. Okay, a level term is just everything is level. The death benefit. So, for example, if I take a death benefit, I take a policy for the death benefit where my death benefit is level 500,000. Okay, so my death benefit will be 500,000. It's not going to be less, it's not going to increase. As long as I keep paying my premium, say, for instance, if my premium is $50, I keep paying my $50. If anything happens, my beneficiary will get 500,000. Okay. Now, another thing we need to know with term insurance is the fact that you can customize it to suit your needs. Okay, it's term, so whatever your premium is, that's what you continue to pay until the very last day, your very last day on earth, right? Mhm. However, there's another form of insurance called decreasing term. Decreasing term is the one that this my 500,000 death benefit will be on the decreasing. Let's say I started in 2020, my death benefit was 500,000. As I continue to pay my premium, fast forward to 2025, my death benefit could be reduced to 450. So you may be wondering, Joy, why should I be paying life insurance premium? My premium doesn't reduce, my premium is still $50, and my death benefit is reducing. Yes, because in exam they are going to ask you that um XYZ that is looking for the cost effective way, of having paying off their mortgage in the event anything happened to them. The answer will be term insurance on a reducing basis, on a decreasing term. Okay, this one is good for people that want to use it towards paying their mortgages, because as they are paying their mortgage balance is reducing. Okay, so, and that is what banks sell to people all the time. Banks sell this decreasing term to people. That's why when I see people, they are buying a house and they are getting um mortgage insurance. One second, please. Anything? I think they're in my wardrobe. Your premiums and the mortgage insurance, the bank is the beneficiary. Your premium is constant from the one. However, the benefits keep reducing. The benefit tracks your mortgage balance, right? And then as soon as your mortgage balance is zero, that life insurance is zero. Nothing else is left. So that is decreasing term insurance. Okay.
That, sorry, that seems
And
like a
also
really,
there's increasing term.
that it seems like a really bad insurance. I don't know why.
Sorry?
I was just thinking about that decreasing term. It doesn't really make sense. It seems like it's not a really good insurance to have.
It's not. It's not. Like anyone that knows, I tell people, like, instead of doing that mortgage insurance, take a life insurance on yourself. And the bank knows when you tell them I have life insurance and you show them, they're not going to force you to take that crap. Okay. All right. So we move on to increasing term. Okay. An increasing term policy has a death benefit that grows larger over the length of the policy. Now, this one, instead of reducing, it increases. And the reason for the increase is the fact that depends on what the policyholder wants because of inflation, right? See, the increase may occur every year or every scheduled, such as 5 years, right? The premium increases in proportion to the increase in death benefit. Yes. So for this one, it's not that the death benefit will be increasing, the premium doesn't increase. No. So as you schedule your death benefit to be increasing, if it's every year, if it's every 5 years or whatever, that is how your premium will increase. Okay. Now, why would some people opt for this? Well, this may be beneficial for some people who anticipate their debts to increase, maybe due to inflation or something like that, right? Mm-hmm. All right. Um, term insurance premium. All forms of life insurance, not just term, charges premiums. Okay. Premium can be paid monthly, quarterly, semi-annually, or annually. All right. Payment could be made by check or by cash or by pre-authorized debit. Okay. Every province charges premium tax on the premium, and the premium taxes could range from 2% to 4%. Okay. All right. These are just preliminary. That's why you see me like I'm not spending so much time on this in this area. Okay. Um, how premiums are set. Let me see how many pages. Now, do you guys want us, like we've done chapter 1, this is chapter 2, right? If we've done chapter 1 and chapter 2, do you guys want us to take questions on chapter 1 and chapter question, chapter quizzes for chapter 1 and chapter quizzes for chapter 2 immediately, or finish everything, then we'll do the quizzes? I'm busy. Yeah. What do you guys think? Page 10.
How many chapters are there?
Ooh, that's a good one. I have, do I have table of contents? Yes, table of contents. As chapter 3, table of content, TOC 17. Yeah, 12 chapters.
Okay. I don't know. Maybe we should do the questions as we go along. That's what I.
Right? Okay, that's what I thought too. Okay, so on page 10, let me take a quick run. Let's see where the end of this chapter 2 is. Okay.
Okay.
That way we finish chapter 2 now. We do okay. Oh, okay. That way we can see what we've studied right off the back and see how the questions around it are wired right off the back, right?
Mhm.
Right?
Absolutely.
Okay, so let me take a quick. So, okay. With also how the premiums are set, premiums are determined by mortality cost. Okay, mortality costs appropriate the insurance company cost of paying, the death benefit. See, everything is runs on data now, and this insurance company, they have AI too, some artificial intelligence that runs all these things behind the scene, looking at mortality rates and all that stuff to determine how the premiums are being calculated. All those things are things that happen behind the scene. And of course, the expenses, right? An insurance company has many admin expenses to pay from the revenue it earns. So premiums are very important and are the source of revenue from where they'll have to take care of all those expenses. And even the commissions they pay us too as life insurance agents, right?
Mhm.
Renewable versus non-renewable term insurance. You see, I mentioned this earlier. So yes, when it comes to term insurance, well, the features of term insurance, the fact that term insurance can be either renewable or non-renewable. A non-renewable term insurance is one that expires at the end of the term. So if you have it for 10 years, it's expired at the end of 10 years, and that's it. Um, however, with a renewable policy, the policy owner has a right to renew. Okay, and that right is guaranteed regardless of the health, of the insured, regardless of the health condition, right? So the right to renew is usually limited to a certain age, maybe to age 70. Okay. Um, you see, there's a clause say that there are many doubts about future insurability. For example, a client's family health history, may indicate the livelihood of the future. Yeah. Okay. Renewable. Okay, so there's renewable with guarantee rates. So if you want renewable with guarantee rates, right? So insurance company will quote you something like this. So if you take them for 30 years, so it means that in the next 30 years, your premium will be 170. Then by the end of that 30 years, from 30 to 35 to be 190. From 35 to 40, 230. 230, 45 to 50. So you find that as you grow older, it keeps going up. So by the time you are 65, your premium is 610. Who can afford 610 premium?
I know.
At age 65, this is when you are retired. You are not in active workforce. You are now living on your retirement this thing, and then to bring out six something is hard, So that is one of the setbacks of this term insurance. Meanwhile, if this person have taken permanent insurance at this age 30, it's possible that this person may not even be paying up to 170, or maybe he may even be paying 200 at age 30, but it's still worth it for him. And then the thing I love about UL, can you guys give me a second, please? Okay. So yeah, so that is the thing with term insurance. It gets more and more expensive, and even some people don't even know how much their term insurance will be renewing at what cost. So for such individual, they wake up for renewal. Okay. All right. Reentry term with adjustable rate. Reentry term is a form of renewable policy, but is subject to two renewal rates: a guaranteed renewal rate and a lower rate that is adjusted for a good health. Okay, so now you have term insurance, and like this one now is the one that the rate at renew is known. That's guaranteed renewal rate. That's this table we see here. However, there's another option that insurance company can give you, but not in all cases. That okay, because if you opt to do medical and provide them with a good health, then they might give you a rebate that okay, you are still in good health even regardless of your age. Excuse me. However, if you are not opting to do any medical for them, they will assume the maximum risk, which might put the Kendrick. Hey, oh my God. Leave here. And that might put the individual in I was going to say high tax bracket, not tax bracket. That might increase or make the person pay high premium, so to speak. All right, so we move on to convertible term insurance. Well, that is the features that comes with a term insurance that enable the policyholder to convert the term insurance from term insurance to a permanent life insurance policy. Okay. Permanent life insurance policies includes whole life, blah blah blah. Yeah. Why should one pick a term contract that have the option for convertible? Well, to have the security of knowing that you can convert it at any time to permanent insurance, it's again on its own a peace of mind. And also, people that opt for the options to be able to convert their uh, temporary insurance to a permanent one, oftentimes are individuals that know the benefit of permanent insurance, but perhaps maybe at this point they don't, at the time of setting up the temporary insurance, they don't have enough means for. It's in daycare. We'll get it tomorrow. Okay. So maybe they don't have enough money at that time to be paying for permanent insurance. So instead of not having anything at all and leaving themselves and their family so vulnerable, so they can opt to start somewhere with temporary insurance and then convert it as their financial situations improve. Okay. All right. And also people that have, they fear that in future they may not be able to get life insurance, maybe due to their health or family history. Then having the ability, a term insurance with the convertible option, will enable them to convert at a future date without having to go through insurability process. All right. All right. So let's move on to incontestability and suicide provision. We know this now, but again, let's just drive through it real quick. Now, when we talk about incontestability period, let me take them one by one, okay? A permanent policy issued after conversion is considered an extension of the initial term policy, okay? So the policy holder is exempt from a new contestability period and suicide exclusion period. So the contestability period is a 2-year following the issue date of the policy. During this time, the insurance company can void the policy. Oh, you want another one? Okay. All right. So now, incontestability period is, and the suicide provision is 2 years. All right. So when a new policy is issued, 2 years, if the individual commits suicide in the first 2 years, that policy will not pay. And then if any material fact, is determined in the first 2 years, then the policy will not pay. Incontestability means that you, as the owner of the policy, cannot contest the decision of the insurance company. That's why incontestability period. Does that make sense? Look at it this way. Oh, thank you. Huh? Okay, you eat it. Thank you. Look at it this way now. Like, okay, you have the policy, and then the it's a contract between two parties, and now the insurance company is now telling you, oh, sorry, we can't insure you anymore. In a normal sense of it, you're supposed to contest that decision, right? However, this is telling us that you cannot contest it. On what ground is it that you cannot contest it? Let's say they found out that you hide some material facts, and they found out in that first 2 years, right? So that's a incontestability period and suicide provision. So what this is
Will they
telling
give
us
you
is that
back
if
your
you have a term
premium?
insurance,
Would they give you back your
me or
premium?
more. No, now it depends on the this thing, because if it's determined that yes, you lied or something like that, and they may not. So I've not heard of anyone that they gave back the premium. I don't think so. But that's the question I could ask. Okay.
Okay, thank you.
So now let's say you have term insurance for 10 years and now you've converted it, right? The question now, what they are explaining to us is that because you've converted your term insurance, it will be unfair for you to now start going through contestability and the suicide provision. Do you understand? So what they are saying is that a converted term insurance doesn't have to wait for another 2 years or go through a suicide provision of 2 years. Make sense? That's why they are telling us, they say the suicide exclusion period is the 2 years following the issue date of the original policy. So if the life insured commits suicide during these 2 years, then the insurance company can deny the death benefit. Okay. Now, suicide commitments after 2 years, suicide exclusion period is covered. Okay. Antecedent age versus original age conversions. Let's pay attention to this one. This one, it comes all the time. Okay. Now, when a policy is converted, the permanent life premium that replaces the term premium may be based on the attained age of the life insured. That is, the age of the life insured on his last, nearest or next birthday, depending on the administrative policy of the insurance company. The original age of the life insured, the age of the life insured when the policy was first issued, premium for the permanent life insured are less when the original age of the life insured is used. Example, Manuel bought a term life insurance policy on August 22, 2020. His date of birth is November 1st, 1986. His premium will be based on age 33 if attained age is based on his last birthday. Age 34 if attained age is based on his nearest birthday. Age 34 if attained age is based on his next birthday. Attained age conversion refers to the attained age of the insured. So does it mean that insurance company uses different age definition for attained age?
Llqp.
Are you guys with me?
Yeah, I can hear you. Yeah, I was just thinking about it. No, I don't think so.
Yeah. See, attained age conversion refers to the attained age of the insured at the time of the conversion of the permanent policy. If in the case of an original age conversion or retroactive conversion, a lump sum payment must be made when the policy is converted that brings the policyholder in line with what his cost would have been had he chosen the permanent policy in the first place, and this can be a significant sum. So in this instance now, these three examples about Manuel, age 33, if attained age is based on his last birthday. But oftentimes what I've seen, insurance company does in all the programs I have been using is that their attained age is usually the nearest birthday.
Yeah, that I agree. Yeah.
It's usually, and that is why, like, big boy, can you live here? Because, go get some rest. Like me now, that I am January 21st. You see, that's my birthday. So January, February, March, April, May, June, July. So by July 21st, right?
Mhm.
That is the thing. If I were to do anything insurance by July 22nd, you see that my age will now be 46, because they are using the attained age they are using is the nearest birthday. Right?
Yes.
But if I were to be doing anything on July 20th, my birthday will still be 45, which is still the nearest birthday, right?
So the cutoff is what? After 6 months? Or
6 months, yes.
so your real age 6 months goes to the next age.
Yes, yes. You see?
So who's paying this?
Um,
Who's paying this lump sum? Is that the policy holder?
yes, they probably like this guy. What they were explaining to us now is that this guy now that initially took term insurance and wants to convert it to permanent insurance, and then now he now see, let's say he had term insurance for 10 years, right? And now he wants to convert it to permanent, and he now see that, oh my God, the money he's paying now is way too much, because now he's 10 years older, right? Now he now went to insurance company and say, what do I need to do to now give me this policy at the original price that I would have gotten this permanent insurance, at the original price I would have gotten 10 years ago. The insurance
Okay.
company now say, okay, we can do that, but you have to pay a lump sum accumulation of premiums that I would have paid 10 years ago plus some interest, right?
That's a lot of.
Which for me, which can be a lot, and for me, it doesn't make sense. If you have that money cumulatively, then figure what to do with it, right?
Investing in other ways, yeah.
Yeah. So now insurance, term insurance is not completely bad in its own wherever, because there are also things that term insurance is best for, that permanent insurance is not the best fit for. Like we learned in our segregated fund, investor profiling, looking at our clients and be able to come up with a better plan, not about making the sales, right? So now advantages and disadvantages of term insurance. It's term insurance advantage. One of the first advantages is the fact that it has low initial cost. Okay. Premiums are guaranteed over the term. If you have term for 10 years, your premium is the same over that period. It has renewable and convertible features. Now, this renewable and convertible features, not that it's every Dick and Harry term insurance that have it. So it's a feature that should be added on the term insurance. And then term of coverage can be customized to meet specified needs. Like if my needs for term insurance is for 10 years or 5 years, I can take a term insurance for that duration to be able to specifically meet my needs for that period of years. And what are they said by premiums and coverage are not guaranteed beyond the term. Like for instance, if I take term for 10 years, yeah, but that's about it. After that period, I'm on my own. Then premium increases after the term. Of course, that's what we just talked about. Um, Yeah, and the premium increases as the life insured ages or grow. Coverage is usually not available past certain age. I told you guys that there's only few companies that provide up to age 80. Our policy is worthless at the end of the term. This is so true. Let's say you take them for 10 years, nothing happens to you in 10 years. And then 10 years, one day after the 10 years, then the risk now happen. That one can be very painful. And it's
Yes.
possible it has happened to somebody before.
Yeah,
So
definitely.
it's very worthless. Yeah, very worthless outside the term. However, you can use term insurance to to protect against temporary risk, short-term risk, decreasing risk. If you have the risk, let's say you're owing somebody 1 million, and this 1 million is structured for 10 years. Let's say maybe every month you're paying 50,000. So it's reducing. So you can take a reducing balance term insurance such that anything happens to you. So those are the okay, so moving on to whole life, but I want us to, we've covered chapter 1 and chapter 2 of life insurance. So what I want us to do now is to take the questions for chapter 1 and chapter 2. So Richard, that was what Linda and I, we discussed that time you stepped out briefly. We talked about because the life insurance have 13 questions. Are you with me, Rachel?
I'm with you.
Okay, so we now thought that, okay, should we cover everything like we've been doing and then do all the practice questions, or since we have opportunity to chapter by chapter questions, now we've covered chapter 1 and chapter 2. Let's deal with chapter 1 and chapter 2 questions and answer them. That way we can directly relate it with the topic in each chapter and have a better understanding on how the questions are being asked around the topic itself. What do you think?
I agree with this strategy.
Okay. So today is Thursday.
How many
So
chapters in the book?
13.
It's different from the other one.
Oh, he's a monster.
Mm.
Okay, so I'm going to stop sharing my screen so that I can quickly launch this chapter by chapter quizzes for life insurance. Chapter quizzes. Kendall, you won't go night night, my boy? Okay, go meet Dada. Mommy will soon come. These boys won't sleep until they see me.
I know it's peak period for the family. So everybody wants your attention.
I'm telling you. Yeah. Okay. Okay. All right. Let's do this. You guys can see my screen, right?
Yeah. Mm-hmm.
So I have the first one. Cameron loves cycling. He goes cycling every weekend. He has the option to bike in one of 4 locations. The safest is indoors at his local gym, and the riskiest is mountain biking down a stair cliff in the Rockies. Cameron chooses to bike in his local strategy. Does Cameron implement? A, risk avoidance. B, risk retention. C, risk transfer. D, risk reduction.
Risk avoidance.
In one
Why is it not
of 4 locations, the safest. Sorry, I didn't hear you.
I said, why is it not risk reduction? I'm not contesting, but I'm just asking.
Me, I'm leaning towards risk reduction too, because I say he has options to bike in 4 locations and the safest is indoors, but that doesn't eliminate the risk.
No, it doesn't. No.
Okay, let's take risk reduction. I agree with risk reduction.
Yeah. Okay. So
because
let's
if he doesn't
move
bike
on
at all,
faster.
then we say it's avoidance.
Yeah, if he doesn't bike at all, that's avoidance.
Then we'll have said he has avoided exactly. Yeah. Okay. Albert, a 68 years old retired man, organizes many activities for impoverished families in his community. Given his age, he cannot help as much as he did in the past. However, he is concerned that he will no longer be able to help these families when he dies. and decide to purchase insurance to cover the cost of continued help for the families when he passes away. What is Harvard insurance needs? Debt repayment, funding a health program, estate creation, lost income. Kendrick, that's sharp. Can I have it, Baba? You want to cut? I'm worried you might cut your finger. That's my worry. So which one is it?
I think it's C.
Mm-hmm. I would think so too. I don't see how he's funding a health program or whatever, right?
Yeah.
Um, Abishola. This one sounds like a Nigerian name. Anyways, Abishola won a free a free cruise to the Caribbean. She's excited about winning the trip because she rarely travels. But she is worried that something will happen to her on the ship. Abishola's sister told her to purchase a travel health insurance. But 2 days before her trip, she decided to give the price to her sister and stay home instead. What risk management strategies is Abishola applying? Is risk avoidance, right?
Avoidance, yeah.
Eh?
Yeah, avoidance. She does not want any risk.
She forgot give me now.
I know.
Oh dear. Monique is a stay-at-home mother to 5 school-age children. Her husband Rashid is an anesthesiology and works long hours at the hospital. Monique gets the children ready in the morning, runs all the errands, and basically keeps the household running smoothly. Rashid has an individual insurance policy and group insurance coverage at work that will cover all of Monique's expenses if he were to die prematurely. But Monique does not have any coverage. Their insurance agent suggests that Monique purchased a life insurance policy as well. Which of this financial impact was the agent thinking about when he gave Monique that suggestion? Did you give yourself, Awi? Okay,
Lots of
careful.
caregiving, lots of income.
The loss of income, estate creation, income taxes, loss of caregiver.
Yeah, lots of caregiver.
Sure, I will think so too. All right. According to the latest data from Statistics Canada, 50% of Canadians men currently age 65 years old will live until age 84.4 or longer, while 50% will die before reaching age 84.4. What does this data represent? Probability of death, morbidity rate, mortality rate, life expectancy. Ah,
It's life expectancy.
Life expectancy.
Yeah, life expectancy.
why not mortality rate? Hmm? No. Emera, take it easy, please. Huh? It's okay. Come. Hey, don't give him scissors again.
Can I have it? Can I have it, Kendrick?
Thank you. Okay, go meet daddy. Here. So why not mortality rate? I'm just curious.
Because it's
Also,
focused on how long they how long length is expectancy.
Okay, so it's life expectancy, right?
I think
Yes,
so.
I think so too. Yeah, we agree on that.
Okay. Question 6. Steve and Sonia have recently purchased a house. Okay. They have installed smoke detectors in every room and ensure that valuables are locked in a fireproof safe. Which of the following risk management strategies Did Steve and Sonia use risk avoidance, risk reduction, risk retention, risk transfer?
Why is it not reduction?
Yeah, I kind of
Thank you.
agree that is reduction too. Yeah, if there's fire, it will be reduced, right? Those essentials will not go.
Reduction as well.
Uh-huh.
Okay. Okay, press it, press it. Yes. Okay. Okay. Caleb and Avery, a couple in their 30s, have two young children. Caleb is a truck driver while Avery is a stay-at-home mom. They have a few assets and have recently purchased a condo with the help of their savings and a mortgage of 195,000. While applying for mortgage, the lender insists on purchasing a mortgage insurance. Why is the insurance necessary in this scenario? A. Caleb has a great mortality risk because he is a truck driver. B. To repay the mortgage if Caleb passes away unexpectedly. C. To prevent income tax liability after Caleb's death. D. For the purpose of estate creation. Which one is it?
To pay, yeah, B, to repay the mortgage.
B.
B.
Okay. All right. Owen is terminally ill. He was never married and has no children, but is very close to his sister Martha and his 13-year-old niece Emma. Owen has 150,000 invested in his RRSP that he would like to leave it to Emma. Can you call me daddy, please? This is getting too much. Okay. Owen is considering what might happen if he dies while Emma is still a minor. Identify the correct scenario from the following options if that happens. A. Emma will receive the inheritance directly and pay taxes at the marginal tax rate. Emma's mother will receive the inheritance on Emma's behalf tax-free. Emma will receive the inheritance directly tax-free. Emma's mother will receive the inheritance on Emma's behalf and will pay tax on the inheritance. So which one is it?
We know tax will be paid. It's in A or D.
For sure.
Yeah, so it's between those two. But it doesn't say what age. Is he dying with Emma at 13 or we don't know? Or still a minor? It will go to the mom, right? And then they can't pay to a minor. They have to pay to...
So which one should we go for?
I think we should go for G.
D, okay. All right, moving on to question 9. Annette and Marcelo meet with their financial advisor, Jose, for a financial planning session. Jose prepares their retirement plan. No, my mouth is full. I can't eat it anymore. Yeah. Where am I? Oh my God. Jose prepared their retirement plan and advises them to purchase 2-term life insurance policy with a death benefit of 250 each. Annette would like to negotiate the premium, but Jose tells her that this is not possible because the insurer premium determines the premiums. How do insurance companies set their premium rates? Based on the death benefits paid over the last 20 years, through a personalized questionnaire during the life insurance needs analysis. Premium rates are based on the family health history, based on life expectancy and likelihood of death.
B.
Go back up. Sorry?
B. It's not B.
Go back upstairs.
If it's not B, then
Okay,
it's D.
B.
But I think it's B.
Okay, based on personalized questionnaire, I know now.
Okay, D.
I think it was C, based on family health.
I think it's D. I'd rather go with D. But I thought B
Yeah,
because normally you ask several questions. You know, I know that there are questions that you normally ask. That's what I thought, you know, when you are trying to do.
But the question you normally ask is for underwriting purposes, but the actual data that is programmed behind the scene into the software that you use to run scenarios doesn't come from the data you are sitting down to ask. It's coming from data that have been analyzed. You understand?
I agree, yeah. That's why I said it's not B.
And then codes were built based on those data. You know? So I'm leaning towards D myself, but I'm open to see what the correct answer would be, right? Jerome works 6 days a week at a grocery store that offers its employees a generous group insurance plan. Virginia, his wife, takes care of their daughter, Corinne, full-time because the little girl has a serious lung disease and has several hospital appointments. They have other financial obligations such as repayment of their mortgage and their car loan. Their friend Michelle advises them to meet with a life insurance representative to protect their family in the event of Virginia's death. Which of the following is the main reason why Jerome should consider purchasing a policy on Virginia's life? The death benefit will be used to pay for Karen's future educational expenses. The death benefit will be used to pay for Virginia's funeral cost. The death benefit will be used to pay for caregiver for Corinne. The death benefit will be used to pay for Corinne's medical expenses. You guys talk to me. Who is your daddy? Before you talk to me. Are you guys there?
We need to read the question again. It's confused with Virginia,
Yes.
many people, Jerome,
There's a
and
lot of things going on here.
This is very simple. They're just trying to distract you guys.
Okay.
We have even solved 2 questions around this today now.
Okay, so the policy is on Virginia. Virginia is the wife. Okay, so if she dies, the loss of caregiver. So
yeah, should be C, right?
Yeah.
I would think so too.
Yay! We did it!
By
10 over 10.
100%.
Oh my God. Let me take this picture and post on the group.
100%.
Please put our names.
Yes, so
The beautiful ones are not yet born. Awesome.
I know. I can't remember the last
I think this chapter by chapter, studying and solving the question, it helps drill the understanding deeper. I think it's a strategy.
Yes, I think so.
We did this, hey. This is exciting. That's with the rejoice like say we don't pass provision.
I know. Na good move.
So it means we're understanding the concept, you know.
That's
Awesome. I love this. Okay, let's quickly do um chapter 2. You know, we'll study chapter 1 and 2, right? Yeah, let's quickly do chapter 2. And I really appreciate if we can do some marathon this weekend, because if we are doing it chapter by chapter like this, then it would be nice for me to have company. Otherwise, it would be boring.
it's true.
Yeah. Let me share my screen. Oh, this is exciting. Okay, let's do this again. Aha. You see, I told you guys this thing will come. Mark was born on November 21st, 1977. On August 25th, 2002, he bought a convertible term life insurance on his life. We need to note down the timelines, right? November 21, 1977. And then we have August, right?
Yeah.
August 25, 2002. On August 25th, 2002, he bought convertible term life insurance on his life. His insurance company uses the nearest birthday to determine the attained age. On February 15, 2016, Mark converts his policy into a permanent policy. Calculate what will be the age used to determine the permanent insurance premium, or if converting is done at the attained age. And meanwhile, they told us that the insurance company uses the nearest birthday to determine the attained age. The nearest birthday. So, how old is he from November 21, 1977 to August 25, 2002?
So he's 25 at that age.
But he converted in 2016, if I'm reading this incorrectly.
So,
Yeah.
yes.
Yeah.
So,
Yes.
here is 25, right?
Yeah, when he
Now,
got the
but they are telling us now that he is converting on February 15, 2016. So now you look at his date of birth is November 21, right? So 2016, 1977, he's 39.
yeah. Well, not quite, right? Because it's not November yet.
Because it's not November yet,
But he's
right?
yeah.
But it's more than February 15th to November. This is more than it's more than 6 months. So I would say he's still 38, right?
Yes, I agree. 38. Yeah.
Eh?
I agree with 38 too. Yeah.
What would be the age to determine permanent insurance premium if conversion is done at the attained age? So it's 38, right? We agree?
Yeah. He's not had his birthday yet.
Yes.
Yeah.
Okay. Camilla is raising her two young boys, aged 3, 5, and 5, on her own. She earns a modest income and wants to make sure that in the event of her untimely death, her kids are taken care of financially until they are adults. What product will suit her insurance needs? A.
A.
Universal life. B. Term insurance. C. Whole life. D. Joint life.
A.
Okay.
Because of the life insurance and the, is it the death benefits portion? The cash value part of it.
Whole life has cash value too.
Hmm.
But
So
the
what's the
universal
difference?
life might be expensive for her, right? So if she's only on
Mm-hmm.
modest income, so maybe the term would be a better option because she will still get something. No, there's no death benefit in term.
So I won't take term at
No.
all.
There's
No,
no
there's
death.
that benefit, but
Just
what if
life,
nothing happens to her outside the term? Yeah.
long
No,
life.
so the whole life will be a better one then, because it's not as expensive.
Whole life. Whole life is the most expensive form of life insurance.
Oh, okay.
I'll take you.
They say she earned modest income and wants to make sure that in the event of her untimely death, her kids are taken care of financially. Kendrick. Anyways, let's go with UL and see what becomes of us at the end. I hope we will hit 10-10 again and break record. Anyways, Mario and Serge are in their early 40s and are equal shareholders of a shoe store. The market value of their shoe store is 500,000 and they estimate each person's share at 250,000. They decide to meet with a life insurance agent to purchase life insurance on each other. They mention to their agents am I doing chapter 2? Okay, chapter 2. Okay, I want to be sure because I can't remember. Okay, they mention to their agents that they are looking for economic solution because they already have a lot of expenses to bear. Which insurance policy should Mario and Serge take? They should both purchase a 250 20-year term insurance on each other. 250 joint last to die permanent insurance policy. They should both purchase 250 permanent insurance policy on each other's lives. They should purchase 250 joint first to die term insurance policy.
The first to die, right? Because they'll have some money with when the first person dies.
Mm-hmm. Yeah. And the reason I'm leaning towards first to die also is because they have a lot of expenses, so they're looking for something at a cheaper option, right? So Ganesh, who is 40 years old, neglected to save money and has accumulated 100,000 in debt. Egbe. Omo. The woman we come marry this one, don't marry liability. He married recently and decided.
Oh, no, women, we follow. We don't think liability.
Wahala dey. The thing waves people they see, eh? Wahala wey high heel, man. Anyways, ah, okay. This woman should better fasten her seatbelt too. Okay, he married recently and decided to cut back on his expenses and to make debt repayment as his primary goal, which is predict will take him 5 years. He also wants to purchase a life insurance policy that will take care of his wife in the event of his death. However, he cannot afford the high premium of whole life insurance, but would like to consider it when his debts are paid off. He would still like to purchase a life insurance policy immediately. And what is the best policy to suit his needs? Convertible term insurance, universal life, 5 year, 100,000 decreasing, 5 year term insurance. Guys, talk to me. Eh? Before you talk to me. Sorry.
So
This is pretty much
the
straightforward.
universal life would benefit him, won't it?
No, no. He has to take a convertible term life insurance because he doesn't have money now. But at the same time, he wants something as a placeholder. So taking,
Yeah.
a term insurance that he
Wait.
can convert when he's done paying his debt to permanent, where
Okay.
he will now be able to afford it. You
Okay.
understand?
Okay.
Mhm. Yeah, makes sense.
Ah,
Okay, Elan, 35 years old, purchased a convertible term life insurance policy 10 years ago when he was single. Now that he is married and his wife is pregnant with their first child, he would like to convert it to a permanent life insurance. Ellen wants to make sure that the premium for the permanent life insurance are based on his original age of 25 years when he first purchased this policy. Okay, you guys remember this, right? The insurer told him, tells him that he will have to pay a sum of 5,000 in order to avail himself to the conversion rights. Why does he have to pay this extra money? The insurance company's investment income has not met the target in the last 10 years and must offset losses in order to maintain the contract. The insurance policy contains an original age conversion that requires Elan to catch up on premiums and pay lump sum when converting the policy. As the probability of death is higher at age 35, the insurer may require an increase in premium and make up the lower premium when it was a temporary policy. The insurer requires a lump sum for conversion since his dependent status have changed due to the addition of his wife and a child. So which one is it, folks? Can you boys go meet daddy upstairs now? No. You guys, oh God. I'll say it's B. I'm leaning towards B, except you guys say,
no, I agree
huh?
with B. I agree with B.
Yeah. Okay. Simon is the proud owner of a restaurant named Sushi Inc. The restaurant has an excellent reputation thanks to its chef, Ong. Simon is worried about the success of his restaurant if Wong were to die prematurely. He would like to purchase a life insurance policy on Wong Life and use the benefits to compensate the restaurant for the significant financial losses that will occur if Wong died. Who are the insured beneficiary and policyholder in this scenario? Suchi Inc. is the policyholder of the contract. The beneficiary and Wong is the insured person. Simon is the policyholder of the contract and the beneficiary and Wong is the insured. Simon is the policy holder of the contract, Wong is the insured, and Suchi Inc. is the beneficiary. Suchi Inc. is the policy holder of the contract, Simon is the beneficiary, and Ong is the listing. So it's between A and P, but I'm looking to see, is there anywhere they told us is Suchi Inc. that Simon is the proud owner of a restaurant named Suchi Inc. The restaurant has an excellent reputation thanks to his own. Simon is worried about the success of his restaurant if Ong were to die prematurely, so he would like to purchase a life insurance policy on Ong Life, and it's used to compensate the restaurant for the significant financial losses that will occur.
I think it's C.
Eh?
I think C too. I'm leaning towards C.
Yeah, it sounds more like C because he's buying, he's a policy holder. Hong is the insured, and the beneficiary is the restaurant.
Please, don't just stop. I don't know why. Okay, wait. You want to eat? Let me finish. Oh God. Have they not given you yet? Okay, so which one is it then?
I think we agreed with for C.
See. Okay. James and Patricia bought several properties near a lake for rental purposes. Now retired, they are proud of the current value and rental income on their investment and enjoy their life without financial worries. If one of them dies, the surviving spouse will be financially stable. Their only son, Matthew, will be the heir to all their assets when they die. In the event of their deaths, the estimated tax burden will be 200,000, and they do not have the fund to cover that amount. They are worried about Matthew. Which insurance options will James and Patricia purchase to cover their tax burden? A joint last to die life insurance policy, 200,000. A joint term first to die life insurance, 200,000. A 200,000 20-term life insurance contract on Patricia's life. Two individual 200,000 20-year term life insurance policy on James Patricia's life. I explained this way. When you see this, for me, if I see this, I'm not going to even read the whole answer. I just pick a straight. Is a joint last to die. Anywhere you see questions like this, it's talking about estate planning. It's talking about the payment. This tax payment will not trigger until the second spouse dies.
Mm-hmm.
Yeah. So it doesn't make sense to use joint first to die. You understand? They are stable, they are financially stable. And they even, this person is so generous, they even tell us that even when the man died, Patricia will still be stable financially. So they are not worried about anything when one person dies. Their worry is the tax element that will emanate on their son when they, so it's joint last to die for estate planning. Okay?
Yep.
Excuse me. Awesome. Sophie and Daniels have 2-year-old twins. Both parents work during the day, so they pay for daycare services for their children. The annual daycare costs are significant, and the couple figure that they will need these services for another 10 years. Sophie and Daniel knows that if one of them dies, the survivor will not be able to afford the cost of daycare with only one income. Which of the following term insurance option will meet their specific needs at the lowest cost? Anywhere you see lowest cost, what should jump in your head should be decreasing policy. Okay, when you see the lowest cost and they are giving you this kind of scenario, you see increasing joint first to die, no. It's not level. It's not level. So you should be looking at, it should not be decreasing joint first to die, or you see increasing joint first. So it should be decreasing joint first to die, because they say lowest cost possible. Do you guys understand? JJ, if you say increasing joint first to die, so it means the benefit will be increasing, but they've already given us the need for the next 10 years. If first to die dies in the 5th year, is it going to be for another 10 years? No, it will be, you understand?
So
That's why I'm leaning towards this one.
so the surviving partner can get the money as soon as the other person dies.
Yes, yes, yes. Let's say 5 years into it, because they figure out the need. They've given us timeline. If they didn't give us timeline, it's a different thing. They've given us timeline for the next 10 years, right?
Mm-hmm.
So that is why. So anyways, note it, question 8. Simon is a healthy 30-year-old and is a non-smoker. He would like to buy a 250,000 10-year term life insurance policy, which has a monthly premium of $54. How will Simon pay taxes on the calculated monthly premium? The premium tax will be additional to the 54. There are no premium taxes. The premium tax is already incorporated into the 54. The tax will be added to his income and are taxable annually. The premium will be premium tax is already incorporated into the 54.
Okay.
Because at the time that we use our software to generate a premium for clients is not going to pay anything on top of that again. That is the deal, right?
Okay.
Okay, question number 10. Cindy, a widow, is the sole owner of a cottage by the water that she acquired many years ago for a total cost of 75,000. Today, the property is worth 650,000. It is estimated that the market value of the cottage will increase by 5% each year because of the rising demand for waterfront properties. Cindy plans on bequeathing her cottage following her death to her only son, Carl. She does not want her son to be forced to sell the cottage to cover the income tax that will have to be paid on the capital gain of the cottage when she dies. Which type of life insurance would be the best to cover these insurance needs? Decreasing benefit insurance, decreasing permanent. It can't be decreasing because increasing permanent insurance, decreasing term insurance, increasing term insurance. Oh boy.
So what are we saying? Decreasing term insurance?
No, it's not decrease.
Maybe
No, you
10.
can't use term insurance to cover estate planning. Okay, it's increasing permanent insurance
I know
because
it's
they told
permanent,
us,
but I don't know why it's increasing. Why is it increasing?
because they told us that the value of the price, it goes up 5% each year. So this is the inflation rate or whatever market rate or whatever it is. It means that this 750 every year, additional 5% will be on it. So if she plans based on this 750,000, right? It means that in the next 10 years, this whatever insurance coverage she has taken based on this based on this 50,000 will not be enough to take care of the capital gain tax, right? Why? Because they've told us that the value of the cottage will be increasing by 5% each year because of the rise in demand. Do you guys understand?
Mhm.
Let's not talk too much. We'll see.
100% again.
Pam, 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 pam.
Oh, that's so good. 80. Oh. Mhm.
That's good. It's good to do something when the brain is hot too.
Yes.
Yeah, the person who takes out the policy, yeah,
Oh my
is the
God.
owner and makes all the decision. Yeah, so it's I think it's Simon is a policy owner and beneficiary.
Oh, so
So
Simon.
let's see the other one that we missed. Mm. Where is it? Oh, this one.
Okay, please go back to that one. I wanted to see. I don't know the Huang and the.
There are several. Wangi. Take a screenshot.
Let me take a screenshot. Thank you. Oh, my phone. Done.
Yeah.
Done.
Remember.
So
All right.
what is the
So
answer? The correct answer there is what? So he's a policy holder and a beneficiary.
oh. All right, guys. So this is where we come to the end tonight. So this strategy we are adopting, so it means that
What's the answer? Sorry,
I
what's the
need
correct
everybody's
answer for number two?
commitment.
What was the answer for number two? What did we say?
Number two, let us. They say there are several types of life insurance, but Camilla needs insurance for a specified period, that is until her kids are adults. So term insurance usually covers. Oh, so she needs term insurance. Oh my God. Oh my God. Oh. Okay, guys. All right.
Okay. Sorry, can you just go back to number 6? I
Are we
missed.
there?
Yeah, just number 6, please. So I can take a screenshot. I forgot to take a.
Yes, please do.
Thank you.
All right. So please, we need to move forward faster. And then this weekend, we're going to do marathon, okay? Life insurance.
Okay. Thank you.
All right. Thank you, everyone. Where's my...
Thank you.
Let's,
Good night.
Good night.
thank, good